I've been asked to talk today about financial services. Very important, especially in a downturning economy. I get a lot of client calls. Oh my gosh, what's going on with my money? Should I move my money at this time? But what I'd like to discuss today are 3 topics that I think are very important to you as an individual and as a small business owner. The first one is legislative updates, specifically the Pension Protection Act that was just recently passed. Secondly is fiduciary responsibilities as a small business owner if you plan to add a retirement plan. And lastly, just close with how do you choose a financial advisor? So let's begin with the legislative updates, Pension Protection Act. Many of you might or might not know, President Bush signed into legislation January 1st, 2008, the Pension Protection Act. You might be thinking, well, big deal. Well, for us financial advisors, it is a big deal because there is not a lot of pension legislation that has been passed in the last 20 years. So what that means is it created a lot of opportunity for you as an individual to not only save money, but also keep it through strategic tax planning. And we'll discuss a little bit about that in the next couple of slides. But essentially, through the Pension Protection Act, what I'll talk about are 4 topics that are very important. The first one, Roth IRA conversions, non-spousal beneficiary rollovers, also contribution limits for retirement plans, and lastly, 529 plans. A lot of information, but I'll go slowly, and if you guys have questions, I'm happy to answer that. Let's begin with Roth IRA conversions. Before going into that, I'd like to explain what the difference between a traditional IRA and a Roth IRA is. A traditional IRA, you have your contributions go in tax deferred. So you're enjoying an immediate tax benefit. However, when you pull the funds out at retirement, and retirement age for these plans is 59 and a half, you will pay taxes on that money at current ordinary income. So I get a lot of people that say, I didn't know I was going to have to pay taxes in the end when I pull my money out. But that's the way that traditional IRAs work. With the Roth IRA, on the other hand, you pay taxes up front, so it's an after-tax plan. However, when you pull the funds out at retirement, everything, including earnings, are tax-free. So think about that. It's a tremendous opportunity for individuals who are planning to retire in a high tax bracket. So there is one caveat, and you guys probably already know this. If you've tried to go into a Roth and you make more than $110,000 a year, you're not eligible. Here's the good news. Through the Pension Protection Act, from the year 2010 to 2012, the government is opening up a window for individuals to convert money from their traditional IRAs into Roth IRAs, regardless of your income. You will have to pay taxes at that time, but all of your earnings at retirement are going to be pulled tax-free. So talk to your financial advisor about that. It can potentially be a very, very strong way to exit, to retire, and begin pulling funds out, lowering your taxable income at that time. The second part of the Pension Protection Act that I'd like to talk about is non-spousal beneficiaries. This is important because essentially the old legislation only allowed your spouse to roll over your IRA or 401k plan into an inherited IRA in case of death. And within 5 years, your spouse had to take the distributions. Obviously, the IRS wants tax money. The new legislation says anyone that's your beneficiary, not just your spouse, but your children, your family, your friends, are eligible to move that money into an inherited IRA, thus creating no tax consequence. So that's huge. Okay. Contribution limits. How many of you guys remember back when you can only put in $1,000 in an IRA? That was very frustrating. especially come tax season and you're looking for ways to not pay the government money back. Well, nowadays, with the Pension Protection Act and with other legislations, you are now eligible for 2008 to put up to $5,000 this year in your IRA. In your retirement account, be it 401k, 403b, 457, you can put a total of $15,500 in 2008. The government also additionally created a catch-up contribution for any taxpayer over the age of 50. If you fall in this category, the government allows you to put in an extra $1,000 in your IRA for a total of $6,000 and an additional $5,000 in your retirement plan. So a total of $20,500. Think about that. I've had employees that come and say, I can't afford to put that much money in, it's too much money. And we look at the tax bracket and we determine that in the end, they're going to fall into a lower tax bracket so they can actually go to a higher amount without affecting their take-home paycheck. You guys just did your taxes. Talk to your tax advisor. This is key when it comes to lowering your tax bracket. Lastly, 529 plans. Essentially what this is a way to fund college tuition and also decrease your taxable income. And the reason for that is essentially the government treats this as a gift. So you as the donor are eligible to put in $60,000 to a beneficiary, your kids, nephews, any family member. And for married couples is $120,000. What happens at that time is because of the fact that it's a gift, it is completely removed from your taxable estate, which is huge. Now, the Pension Protection Act just added a new part to this legislation, and it's the withdrawals are now going to be federally tax exempt, which is huge. Okay, so a lot of information, but that's all I wanted to go into for the Pension Protection Act. It is a comprehensive legislation. I don't have time to go over all the details, but I thought these would be 4 important points that would affect you as individuals.